USD rate will halter stock rebound. Now, the US dollar may be losing its appeal as one of the few reliable safe haven assets in times of economic and geopolitical uncertainty after an 18-month rally, and the further fall by the currency could fuel the 2023 stock market rally, market analysts said. But a near-term dollar bounce could pose a test for equity bulls. Over the last 12 to 14 months, there's been a clear inverse correlation between equities and the US dollar. The DXY looks very poised for a counter-trend rally here, and we don't think we can get a true sense of the durability of this rally until we see how stock reacts to a rising dollar, said Jonathan Krinsky, chief market technician of BTIG, in a note last week. The ICE US dollar index DXY, 0.45%, a measure of the currency against a basket of 6 major rivals, jumped 1.2% on Friday after an unexpected strong surge in the U.S. January non-farm payroll, which dented the market's perception that the end of the Fed's interest rate increases is near after all. Now, stocks fell Friday in the wake of the data, but the Nasdaq Composite COMP negative 1.59% still logged its fifth straight weekly advance with a gain of 3.3%, while the S&P 500 SPX negative 1.04% held on to a 1.6% weekly gain, led by a continued surge for tech-related shares. The Dow Jones Industrial Average DJIA negative 3.8% saw a 0.2% weekly fall. Now, the dollar may have been poised for a bounce. The dollar index fell to a 9-month low on Wednesday after the Federal Reserve, as expected, raised the Fed funds rate by 25 basis points, lifting its policy interest rate for the 8th straight meeting and signaling more than one further rise is still planned. But the market remained at odds with the Fed's forecast for rates to peak above 5% and stay there instead of pricing in rate cuts before year end. While Powell continued to push back against rate cut expectation and repeated his previous concern about easy financial market condition, he also acknowledged for the first time that the disinflationary process has started. That was enough for traders to bet the rate hike cycle is nearing its end, with cuts soon in store. The dollar surged for most of 2022, with the index jumping 19% in the first 9 months of the year and hitting a peak of 114.78 in late September, as a higher interest rate in the U.S. drew in foreign investors. Now, a surging dollar described as a wrecking ball was blamed in part for a plunge in stocks. The greenback's gain came as climbing treasury yields made bonds more attractive relative to other income-earning assets. The dollar's subsequent overvaluation and market expectation that the Fed would begin scaling back its monetary tightening cycle has been the catalyst behind its pullback, said Larry Adams, chief investment officer at Raymond James. The tailwinds supporting the U.S. dollar in 2022, such as Fed hawkishness and the favorable yield advantage, turned into headwinds as we moved into 2023, he said. Now, John Luke Tyner, portfolio manager and fixed income analyst at Aptus Capital Advisor, said the main reason for the dollar outperforming the rest of the world last year was that the Federal Reserve was leading global central banks in this interest rate hiking cycle. Now, other central banks are playing catch up. Where they're at now in the tightening schedule is behind us, and so as they continue to catch up, it should help strengthen the euro versus the dollar, Tyner said. The dollar strength has eroded in the past 4 months, falling 10% according to Dow Jones market data. The dollar was probably too overvalued based on the ridiculous expectation for the Fed to hike to 6%, where you saw some people getting really giddy in those expectations, Tyner told the market on Thursday. Now, however, while Powell and his colleagues are determined to keep interest rates elevated for some time, investors still don't seem to believe that they will stick with elevated rate hikes in 2023. Traders projected a 52% probability that the rate will peak at 5 to 5.25% by May or June, followed by almost 50 basis points of cuts by year end, according to the CME's Fed Watch tool. As a result, market analysts see the dollar as closer to its end and is likely to fall further in 2023 as inflation cools and recession risk decline. Now, Jim Frater, global strategist at Pacific Investment Management Company, or PIMCO, said the dollar's yield advantage versus other developed economies will narrow as the Fed moves towards an expected pause in his hiking cycle in the first quarter of 2023. Now, Frater and his team said in the note earlier this week that the dollar's strength in 2022 was aided in part a substantial risk premium imposed on European assets for tail risk that Russian energy supplies could be cut off, or even worse, a nuclear event. Now, a risk premium is the additional return that an investor demand for holding risky assets over risk-free assets. Frater acknowledged the possibility that inflation could prove stickier in the U.S. than in other advanced economies, or that monetary policy may be tight for an extended period of time. That would suggest the risk premium in the dollar market could remain sizable but this premium could decline further as a shock recede and evidence build that last year's surge in inflation is well and truly improving and abating. We expect the USD will continue to lose its appeal as a safe haven currency of last resort, Friday said also. However, it's not all bad news. A slide in greenback may catalyze rallies in risk assets such as stocks, which have kicked off the new year on a bright note. As of Friday, the dollar index had dropped more than 10% from September 27 when it hit a two-decade high, while the S&P 500, the large capitalization index for the stock market, has gained over 11% since. At the dollar's 2022 high, the DXY was up 19% for the year, while the S&P 500 has slumped 22% according to Dow Jones market data. Meanwhile, some analysts warn against using the recent inverse correlation between the dollar and the stock as a reason to jump back into equities other than risk assets. It could be that investors are taking this announcement from the Fed and their current sentiment to mean that they can go back into risky assets, but I wouldn't necessarily say it is a guarantee, said Shelby McFadden, senior analyst of Motley Fool Asset Management. Certainly, we can say correlation nor causation. You could say that it's an indication, but not that it is an indicator, McFadden added.